Hello and welcome. So let's do a system check. Can you hear me now and can you see my screen? Can you hear me now? Yes and yes. Excellent. All right. Well, happy Friday, everyone, and welcome to the Coaches Playbook. Just a logistical thing. I do have a hard stop. So the session is exactly going to be a 1 hour session. So just know that. And I kind of wanted to keep it free form. I did have a request to talk a little bit about open interest and basically how to shop a little bit for an option. How do I pick this option versus the next option? So if you would like to see a little bit of that, we can talk a little bit about shopping for an option, and then type in the chat if there's any other direction that you'd like me to spin it. Anything you want to hear about, let me know. Type in the chat, and then we'll hop to it. Does that sound like a good idea, everyone? All right. Let's go ahead and hop to it. So just as a reminder, we need to remind people that we're an education company, and the premise being is that trading investing does involve risks, so we must manage those risks. And I always like to say I could show you the coolest stuff. It doesn't matter anyway if we don't have money management or risk management. Okay. So let's begin. And how about this? We'll keep it kind of keep it free form. Is there a ticker that someone would like me to look at? It doesn't matter. We'll keep it kind of free form. Is there a stock that someone would like me to look at? The Qs. We can look at the Qs. The Qs are a little thick to identify, for instance, open interest. So what about an individual stock? I know I said any ticker, but what about an individual stock? Amazon. Okay. Let's go look at Amazon. And let's see if we see any eye-opening. We can also look at Netflix. Let's take a look here. And so let's start with Amazon. And a couple things. So Amazon, if you didn't know, did earnings today, so they gapped up. But what if you were looking to, today's kind of a bad day to structure a trade on Amazon. It would have been better to do it, obviously, hindsight's 2020 yesterday. But what if we were to wait for a little bit of a pullback before we participate? Okay, so that's neither here nor there. But what if we wanted to either buy calls, okay, on Amazon or sell a put? And the premise being you sell puts where you're willing to own. So currently this thing's trading at 129. Could you sell a put at 120 if you were willing to own it down there? Or if you're willing to let shares be put to you, you could sell a put. And the nice thing about selling puts is that you don't have to wait till it gets down here. You can sell a put right now, right? And if it gets down to 120 in a certain time period, you can be handed the shares. Okay, so with that said, let's go shopping. And so if we look at the option chain, it's like, how do you decide? Do I look at the 7-dayer, right? Do I look at the, what else we got going on here? 140-dayer. Like, what do I do? Well, we like a shorter period if we're selling options. Okay. And the reason being is that we don't want to wait forever, and we may want time decay, time passing to also be a footnote in generating revenue for us. So they talk about time decay. They talk about time decay, or some authors talk about an ice cube melting. Well, what if I were to say that ice cube melting can cause you to generate revenue? Now, I'm not a big fan of weeklies. I do them occasionally. So when I'm doing my weekly sessions, I tend to avoid the weeklies, not necessarily because I hate them, but there are times where if you go look at like a random 35-day expiration, if you look and start shopping, we don't see a whole lot of liquidity. And when someone says liquidity for an options trader, usually they're referencing open interest. And, you know, as options traders, we don't normally look at volume. We look at open interest. Basically, how many people are at the party? Okay. And Amazon is trading at 129. We're talking about the 120s. And so surprisingly, here there's a 300-day, excuse me, this is a 35-day expiration, and we can actually get a $1.80 premium on a $129 stock. And a loose ism to reference, one of my favorites is to reference the premium received in relation to share price. And if we're using that standard, we're getting over 1% on our money in relation to the premium collected from selling a put in this case in relation to share price. And we'd be willing to have the shares put to us. Okay. Now, well, what about the 35-dayer? Okay, well, Sean, can we go look at the 14-dayer? So there's a 14-day expiration, a weekly. Okay. And if we look in here, we can see what we see. So see how this is 1500, and is it kind of sticking out like a sore thumb? It is. And so do you think that somebody somewhere is looking for, how many shares is that? I mean, that your eyes roll back in your head. It's 1500 contracts times 100. Okay, I guess we add 2 zeros to that. 150,000 shares, is that right? Is my math right on that one? But that person more than likely is probably selling puts down here. Okay. And they're willing to own it at 120. And you can see the premium they're collecting. And this is 60 cents on a $129 stock. And so then we're receiving kind of 0.5% on our money. Okay, now sometimes could we look at it, could we go double time to see what's more efficient? Okay, so let's just go shop real quick. If we were to go out to the 28, well, here's the 21-dayer. Let's start there. Okay, and this is a monthly option. The 120s are offering us $1.07. Okay, so we're going out 7 more days. Okay, and we're getting like 50 cents more premium. So for us, okay, I'm going out an additional, again, 7 days, right? And we can kind of do a percentage on that. And maybe you want to see it again. So again, here's the 14-day expiration. We can look at the 120s. Let's call it 66 cents. Okay. And so if we were to go out to the 21-dayer, which is 7 days greater, but then we're getting, shoot, what is the difference in that? Call it 50 cents more premium, or like 80 or 90% more premium without going double time. So does everyone see this here? So why the heck would I do the 14-dayer? I can get 80% more premium if I'm willing to go out 7 more days and do the 21-day expiration. So this is a conversation where, you know, I don't know, what's the analogy I usually share? You know, pushing a grocery cart down the grocery aisle. And, you know, the one that I usually share is peanut butter. My kids put back peanut butter. They've slowed down a little bit, but we probably still go through a pound of peanut butter a week, 2 growing boys in my household. And, you know, so needless to say, I'm not necessarily super sensitive, but I'm aware, that's a good way to say it, of the pricing of peanut butter. And peanut butter is not cheap, especially I usually try to buy the natural peanut butter, the organic stuff. But there's like 8 brands or 10 brands. And so am I looking at price per ounce? How much bang am I getting for my buck? And they're kind of agnostic on the brand of peanut butter. So what if we're similar? We have kind of a ballpark, but then we want to be, you know, smart about it. And so we're looking between like the 14-dayer and the 21-dayer. And I don't know if any of you have taken the time to go shop like this. But again, if we were to go 14 days out, we could get 60 cents a premium. If I'm willing to wait, 21 or 7 days additional, the premiums are, like an additional close to 50 cents, 40 cents, something like that. So it seems to be viable. Now, if we were to also talk about open interest, and again, open interest is the people that are interested at that specific strike, or the people that have done a one-sided order. The tricky thing with options is that you don't know if it's a person buying options, you don't know if it's a person selling options. And so then you kind of have to use common sense. And a lot of people want to know a definition of open interest. Well, open interest, if you think about it, is a one-sided transaction. And the way I always like to share it with people is intentions to buy or sell. Because if I sell a put today, right, we really don't know, or that transaction isn't completed or fulfilled until the full expiration. So think of it, because then you have exercise or assignment potentially. So again, it's kind of a one-sided transaction. And then you kind of need to use common sense. So the fact that we can see 48,000 contracts, excuse me, do you think that's someone buying puts, or do you think it's a possibility that someone's probably selling puts down there? If we were to go back to the chart on Amazon, right, the fact that it lines up with a became a pretty substantial pivot today. Again, it gapped up off earnings. The fact that it pivoted here means that somebody somewhere bought or is still hoping to buy. So that 48,000 contracts means that if this drizzles down to 120, that might have been somebody selling puts. And so I am under a premise that if there's a big open interest underneath current price, especially if it lines up with a pivot, that's probably an options seller. Well, Timothy's chiming in. Is the open interest order already submitted? The answer is yes. But remember, Timothy, it's one-sided. That could have been an option buyer, or it could have been an option seller. Okay. And then that person's waiting till the end of the journey or the expiration to fulfill the transaction. Okay. And so again, the best way I can describe it, I think that the way it's always made sense to me is that open interest is a one-sided transaction. And because it's not because you want to say, Sean, is open interest a completed transaction? Well, All right, everyone, I am back. I apologize in advance. My wireless router occasionally decides to kick me off for no reason. Anyway, hopefully we're back in business. And can you type in the chat? Can you hear me now? Sorry about that, group. It's like, where'd Sean go? Anyway. Okay, where were we? Having fun. All right. So I think I'm sharing my screen, right? Okay, I think we're good. All right. So where were we? Having fun. Okay, so the conversation where we left off was that um, just volume in comparison to open interest. So as options traders, we don't look at volume, look at open interest. And again, the best way to describe it is that it's an intention to buy or sell. Okay. And so a couple more things we can dive into on Amazon real quick is that that this should be pretty glaring to where we're going 7 more days and almost getting double premium, if that makes any sense. Now, if we were to look at the 14-dayer versus the 21-dayer, and we were getting, let's go look at the 120s. If we were getting, again, we can go back to the 14-dayer here, we can get, let's say, 67 cents. And if I were to go look at the 21-dayer and we were getting like, let's say 70 cents instead of $1.07, I was only getting like a nickel more premium for going out an additional 7 days, I would opt to go for the 14-dayer. Now, could we go to like the 49-dayer? Now, what would I think there? Well, if we can get, let's say, a dollar, let's call it $1.10 at the 21-dayer. If I'm going double time, I should be at least be getting double premium. So there are some laws of diminishing return. And so now if we were to go look at the 120, am I getting double premium? I am. I'm getting, 214 would be the jam, but then is it even better? So it's it's what 28 days more, but then are we getting compensated pretty good? Percentage wise, it's not too bad. And you can see there's a large open interest here. So somebody somewhere is still interested in this thing. These two might be the same people. The same people that are selling puts here at the 120s, maybe selling puts at 115. And we're not getting 214, which would be double, which would be a 20, which would be a 42-dayer. Right? This is actually a 47-dayer additional. No, I'm sorry, 27-day additional, and we're getting some icing on the cake. So we're getting an additional 40 cents. Okay, and if we were to think about the math, it looks like price per ounce is a little bit better with the 120-dayer. I'm sorry, the 120 strike and the 49-day expiration. I'll get my thoughts collected here. Now, the 21-dayer, you may not want to wait 49 days to have the shares put to you. So we looked at it. It is more bang for your buck to do with the 21-dayer. It actually appears to be more bang for your buck for the 49-dayer, but do you want to wait that long, for 49 days to see if you're put the shares, right? And you may be impatient, or you may think that it may pivot off of this level sooner, right? And so maybe you don't want to wait 49 days to see if it's going to come down here and you're going to be put the shares. And so then you may go, you know what? I'm willing to do the 21-dayer. It's better than the 14-dayer for efficiency. But maybe you don't want to wait 49 days to see where the dust settles on Amazon, right? And so you may elect for the 21-dayer instead, if that makes sense. There's a comment coming in. You may use a filter on top of the option list, minimum, maximum, 120 strikes, or you have expirations for the same on one screen. Ah, okay. So you can query and price compare. I've never done that, Tim, to be honest with you. You can make me more efficient, right? Pretty cool. I didn't know you could do that. Yeah, would it be, so filter would be up here. Let's see if I can quickly figure this out. Filter, strike price. Minimum 120. See if I can figure it out. I've never done this before, so thank you for mentioning it. 120. And let's try it over here. Days to deliverables, expiration type. And for fun, could we just look at the put side? There you go. I think we just did it. Is that right? We did. It doesn't display. Let's see if it displays. Ah, huh. This is kind of fun. I honestly have never done this. Thank you, Tim. And so we can see here it's more efficient probably to hang in there for an additional 7 days. We were talking about the 49-dayer, and it's definitely double premium plus a kicker on top. So, price per ounce, it looks like it's not so bad with the 49-dayer. Now, you're like, Sean, if I'm going to sell a put, could I go do the 112-dayer? You could, but we don't want to go too far out because we want maybe to see if we're going to be put the shares. We also want time decay. So if you're an options seller and you want to be paid by the clock passing or time decay, we don't want to go out to like an 84-day expiration if you're selling options, because the erosion, or what they call time decay, is going to decay slower than if you did a shorter and shorter time period. So I love the word balance, to where we want to pick a decent expiration that's not too far out, but then theta decay is going to be good enough to erode your premium. And if you want to see that real quick, okay, so now how do I purge the filter? Uncheck all. Okay, now we're back in business. Huh. Well, there you go. Kind of fun. I've never done that with Thinkorswim, and I've been using it for 10 years at least. Anyway, kind of fun. Okay, so where was I going with that? Theta decay. So if we look at the 21-dayer, we can go look at the 120 strike and then look at theta. And theta isn't listed here. So let's put it in. Right. And the 120s, we can see erode 7 pennies a day. Okay. It's 7 pennies on $100.10 premium. Now, if we were to go to the 49-dayer, we were to look at the 120s, it is 5 pennies. So yes, we're getting a juicier premium by going out to the 49-dayer, but then it's eroding slower for us. So then it's kind of a balance. And again, you'd probably opt for the 21-dayer if you think the premium's good enough and you want it to, on a shorter period of time to see where the dust settles, right? Cool. So hopefully some of you are enjoying this, and the conversation being is just, learning how to shop when it comes to options. So talk to me. Do we have any other questions real quick before we look at another ticker? I think the biggest takeaway that what was revealed was comparison contrasting the 14-dayer, right, versus the 21-dayer. Going out an additional 7 days, we're almost getting double premium, and that should be a no-brainer for all of you, right? Now, another couple things that I want to mention about weeklies. The spreads can be wider with the weekly expirations. I didn't click on a weekly here. My mouse is sensitive. So with the weeklies, the spreads can be wider and open interest can be thinner. Okay. Again, the difference between the bid and the ask can be wider, and then open interest can be lighter. So like when I'm doing my sessions weekly, I tend to just skip over the weekly options. Now, if I'm home alone, doing my own thing and my own trading all by my own self, I do occasionally peruse the weeklies. And especially, I know we mentioned the cues before when we just started. If you're looking at the cues, is it worth your while usually to go shopping or weed through the noise and look at the weeklies? Occasionally, yes. Because sometimes you can go 2 weeks out and do a random 14-dayer and get a juicy premium, and you're like, I'm all over it. Okay, so just full disclosure, on my own accord, I usually don't take the time to look at the weeklies when I'm doing my sessions, but it's worth a look when you're all alone. Okay, that makes sense. Now, there was another ticker that you want me to look at Netflix. Any quick questions before we keep going here? Don't be bashful. This session is for all of you, not me. Well, should I ask, are we enjoying this? How about that? These good conversations? Let's look at Netflix. Nobody's enjoying this? Is there anybody out there? Can anyone hear me? All right, so here's Netflix. And what do we got going with Netflix? Okay. So at least one person. Oh, there we go. Got a couple people. Brenda and James are saying they like it. Okay, so at least 2 people of the 19 that are in here are enjoying it. So Tim's chiming in. For selling a put, we have to have the put cash or buying power on hold, not used until expiration. Essentially, yeah, they reserve the amount to be able to sell a single leg put, in that regard. Now, are there other takeaways, Tim, if you're doing debit? So let's back up a second. What he's pointing out, I think, either just stating a point or just confirming, if you sell a put with a broker and it's not a naked put if you have enough money in the account. Okay, so if you have enough money in the account to cover the shares and you sell the put, it's called a covered put or cash secured put. And what if you sell a put on a $30 stock? Okay, and you sell a put on one contract, that would be 100 shares, or 3,000 bucks would needed to be in the account to sell that put. If you only had 1,500 in the account and you sold the put, technically it would be a naked put because you don't have enough money in the account to cover the shares. And that may be okay, believe it or not, if it's a margin account and you have to have normally the top tier option approval to be able to sell naked options. Okay. And I don't know a whole lot of people that do naked options. Normally, if you sell a put, you're getting a paycheck and you don't mind owning, but then you need enough money in the account in case the shares are put to you. Okay. Another question came in, is it worth it to put the cash on hold for the longer expiration? And that's a wonderful point. I like where you're going with that, Tim, because he's comparison contrasting. Let's go back to Amazon real quick. All right. And his point was that, if we're deciding between the 21-dayer and the 49-dayer, is it worth it to sit on this thing for double time doing the 49-dayer or tie up capital for that long just to see if you're going to be put the shares at the 120s? Another way to think of it, Tim, couldn't you do 2 transactions, right? Could you do the 21-dayer, get your $1.10 that you're getting right now, see where it ends up, and then redo it, or see where if it's worth it for you to do another 20-dayer after that? Because in theory, could you do 2 turns inside of a 49-day term? If that makes any sense. So I absolutely love where you're going with that, Tim. And yeah, if you do the further expiration, yes, your money would be tied up longer. And is it worth it to you? And for me, it just depends on my mindset. Normally I kind of have a weekly mindset and then like a longer term retirement mindset. And I do options with both styles. And so for me, for like weekly income, or to see if I'm put shares, I'd be more, focused probably on the 21 dayer, you know, and I may not be in the trade for 21 days. We may sell put it at 120, right? And, what if next week, Wednesday, this premium gets smoked down to 20 cents? I may go ahead and get out of the trade because it's looking like, because if this premium gets down to 20 cents, that would have meant that Amazon kept going to the upside, which means it's not going to get to 120, and I may as well cash my paycheck and get out of the trade, because if this thing jumps to 140, this premium may go down to 20 cents and I could just cash out of my paycheck, because you go ahead and close out the put. And that's another thing to point out is if you sell a put, you're not stuck into the thing for the full expiration. If you sell a put, can you buy back the put later? What if it's been a week? So now there's 14 days left in the 21 dayer. Can you close out of it early because you like the profit? Or it's looking like it's not going to get to 120. So you might as well close out of the trade and cash your paycheck in, right? Kind of fun. And you can see this 48,000 contracts. Somebody somewhere probably doesn't mind getting put the shares. And the quantity here, your eyes can roll back in your head. Sometimes people like to see this. But if you were to think about the math involved here, 48,000, right, times 100. Oops. My mouse is incredibly sensitive. 48,000 times 100 times 129. Or no, it should be 120, right? The strike. So are you kidding me? That's a $500 million trade. Like, wait, what? Is that right? Now, maybe this person is doing it in a margin account, but still, you can think about the math involved. Again, 48,000 contracts times 100 times your strike. So is this a pretty big trade or pretty big account or pretty big, the joke is, could this be like Dodge and Cox Mutual Fund, trying to get shares of Amazon in their portfolios? Could this be Icon? Could this be Soros with this kind of figure? Absolutely. You never know, right? Let's see. Tim's also chiming in. Is the open interest the only criteria we use to determine which strike to take? Well, yes and no. That's a good question, Tim. So he's pointing out, is open interest the only criteria we use? No, we're going to look at the pivots on the chart or the candlesticks on the chart. We also, if you're an options seller, now, if you sell calls, if you sell puts, if you sell credit spreads, okay, so I guess any type of options seller, in general, the maximum expiration that you pick, Tim, is 60 days. And the reason we do that is because we want expiration, or we want time decay. Okay. And we want that theta decay to create a paycheck for us. And the greater, see that we want this to be a paycheck for us. And the further and further we go out in time, right, the slower and slower theta decay is, if that makes sense. So just as a blanket statement, there are some kind of blanket isms, which would be, if you're a credit trader, if you sell options, 60 days is kind of maximum. Now, if you're a debit trader, if you buy options, there's some isms there too. Now, it depends on who you talk to on this one, but I am always an advocate of buying time. So if you buy calls or you buy puts, I usually like to suggest a minimum 90-day expiration, because it's the inverse, right? So if we sell options, we want time decay. If we buy options, we don't like time decay, and that's why we are not cheap and willing to pay more and buy more time, because theta decay will be a slower drip for you. The more time that you buy, if you buy like 140-day expiration, you buy a call on Amazon, your ice cube melt is going to be slower. You know, your erosion is going to be slower. Okay. Yeah. Brenda is saying, so one person doing 48,000 contracts, and that's a good point, Brenda. It could be a culmination of several people, but the fact that it's sticking out such a big chunk like that at that strike, yeah, it could be numerous people. And what a lot of people aren't aware of is you think the banks and institutions compete with each other. They do, but usually it's birds of a feather. You know, so like if Wells Fargo is scooping up Amazon for their house account, you know, Bank of America gets word of it, and then all of a sudden they jump on the trade too. And then JP Morgan and Goldman, like they very rarely are you know, contrarian viewpoints. Some of you may remember the gosh, what was it? It was the Herbalife with Soros and Icon. I think one was long, one was short. You know, and Soros and Icon, they're big enough to be classified as institutions. So are Soros and Icon big enough to be classified like a Goldman Sachs or a Wells Fargo? Absolutely. And so that's a good point. Could it be one person? Yes. But could be several people involved. But neither here nor there. The amount of monetary value there is just your eyes roll back in your head. Wait, that's like 500 mil, Sean. Yes, that one that one chunk of open interest is like 500 mil. You know, cards read, right? So Brenda's asking, what about just buying calls or buying puts? How do we pick the right options for those? That's a great question, Brenda. And I gave you the first ism. The first ism is usually 90 to, I don't know, I'd probably say 90 to 200 day expiration. And that's like, to me, the newer debit trader, the newer, you know, debit trader, you know, does short term because it's cheap. And so that's a good ism to remind yourself, Brenda, is when you buy options, buy time. And that's a fun little ism for you to write down. When you buy options, buy time. Okay. And the reason is we want theta decay to be diminished. Now, in my sessions, if we were to reference it to my weekly sessions, we did a debit call spread. And oh my gosh, it was painful. Okay. I think within 3 days' time, we were up a couple $100 on the debit call spread, but then it went against us. And we had to sit in the dang thing for a month and a half before it finally started to act right. And, you know, thank goodness we did, I forget, I think we did like a 90-day expiration or a 100-day expiration on it, to where we could afford to sit in it for a month just waiting patiently. And yes, time decay was working against us, but we bought time. We bought like a 90 or 100-day debit call, to where we had enough time for it to work out, and theta decay hadn't eaten us alive yet. You know, what I see a lot of newer debit traders do is you buy a call on like a 15-day expiration, and you know, you buy, even worse, you buy an out of the money call on like a 15-day expiration, and you're pretty much guaranteed to lose all your money. And so it's like, you know, you buy long term, hold short term. You know, so you buy a long-term option and you hope to be in it a shorter period of time. Okay, because you don't want to hold for full expiration when you buy options. I don't know if anyone ever mentioned that to you as well. Okay. So hopefully, again, some of you are starting to enjoy some of these isms. Timothy's asking, is there a way to tell if the open interest, large open interest, is a buy or a sell? And Timothy, some of that's just common sense. So like if we go look at the chart on Amazon, we see the 120 strike. What did they do here? Okay. Now, do you think someone could be buying puts, that 48,000 contracts, as insurance? They could, right? Could they be buying puts if the thing drops below 120 for insurance? They might be, But the fact that it's a pivot here, somebody somewhere bought, right? And so for me, probably a bulk of that is people probably are willing to buy back down there again. Because you look at the chart, right? And Amazon's been as high as 145. The 120 levels, shove us back to earlier this year. And Amazon is one of these stocks that people love to own, including banks and institutions. And I can, nerdily, geekily go look up institutional ownership on Amazon real quick. Let's do that. So institutional ownership, looks like 60% of the shares outstanding are owned by banks and institutions, according to what I see. Let's see here. Yeah. Okay. So moving on. And so some of that, going back to Tim, would be some of that would be going back to, common sense, Tim. So would they be buying puts down here? They might be, but what would, to have better insurance, they'd probably do more at the money. The fact that the large open interest here means they're probably selling puts because they're willing to be put the shares at the pivot where someone else bought in the past. Okay. Yeah, Brenda's pointing out that she's been killed trading weeklies, and that's usually where people end up, is that they buy options, like they buy a call with like a 10-day expiration or a 3-day expiration, and you buy an out of the money call because it's cheap. It's like, Sean, this is $50 or 50-cent premium. I'm going to buy this call, because it's out of the money, and I hope it goes up in 3 days. And they don't understand that, they're battling time decay, right? And that's not what we want. Now you can do the same trade. It's just, buy time if you're doing debit, right? Mike is saying, how far do you go for debit spread? Believe it or not, a debit spread, Mike, I treat it the same as a single leg debit. Now, granted, it's insured, so you have a little offset there, but the insurance can decay as well. Whether that can help you, but then it's further out strike. So for me, Mike, I treat it the same as my single leg stuff. So if I normally do like a 90 to 200 day debit single leg, if I'm doing a debit spread, I treat it as such the same, to where I'm kind of doing 90 to 200 days. And Mike, if you're curious, it's beyond what we're talking about today, but a debit spread, whatever you're paying for your single leg premium, usually I try to cut the debit cost in half when I'm structuring my debit spread. So if I'm paying a $6 premium for the debit long call, I might try to find a $3 credit. So then it cuts my basis in half. And that might end up being a wider spread. So when I do debit, I tend to do wider spreads than when I'm doing credit. I don't know if that helps, Mike. Brenda's asking about same day expiration. I'm not a big fan of day of expiration or 0-day expiration. They call it 0 DTE. And there's a lot of stuff on YouTube, about 0 DTE and SPX, spreads on SPX doing 0 DTE expirations. And yeah, just be careful, right? I come across a couple people in my travels over 20 years or so where the people are doing these 1 or 2-day expiration type stuff, collecting nickels, literally a 5-cent premium or $5 premium. Yes, but then they're swinging giant bats to make it worth their while. That may be you, but just be careful on the SPX stuff, because a lot of people can get caught by surprise, and the markets can violently move if they want to, right? So just be careful on that. And again, normally to make it viable, usually people swing big bats. And again, that may not be the best thing for you. So it has to fit within your business model. Okay. Yeah. And so, Brenda, if I could make a suggestion, instead of doing the shorter term stuff, just do a little bit longer term, right? And do further out of the money if you're doing credit. If you're doing debit, buy time, right? And the problem is that with options, we have to pick a time. Let's say you're buying a call, right? Could you do a 1-day expiration call? And let's use Amazon as example. What if it's trading at 128? So let's just say you can buy a 128 call that expires tomorrow. Okay, that means you're only giving it a 1-day chance for it to go up above, move in your favor. Okay, now granted, the premium may only be, Sean, the premium's, 20, 25 cents or 25 bucks for the 128 call with 1 day at expire. I got you. But again, you're kind of shooting yourself in the foot. It has to work in 1 day's time. Now you may be right. You may say, well, Amazon is going to go up, but shouldn't you buy some time? You can still buy the 128 call, but don't be cheap. You might buy the, maybe at least a 60-day, or let's say you do a 90-day call. You're like, but Sean, it's going to cost me 600 bucks. I got you. Yes, the call may cost you $600 instead of $25, but at least you're buying time. You have more time for it actually to work out in your favor. And theta decay on a percentage basis won't be eroding the option so much. And so, now do you have to hold it for 90 days? No. And so the age-old expression, if you're doing debit, buy time. And then, can you arbitrarily get out, And so sometimes I like to say if you've been into a half or a third. So let's say you buy a call that with a 90-day expiration and you've been in the thing for 30 of the 90 and you still haven't been paid yet. It's like, should I just go ahead and cut my losses or roll it and do a brand new debit with a longer term? Okay. All right. So food for thought. Let's see. Interesting. I like the idea. We're doing okay for spread aiming. Yeah, so sometimes when people do a debit spread, Mike, people are freaked out sometimes. You're like, whoa, Sean, you're doing a 20 wide spread. And I'm like, yeah, but it's a debit, right? And we're cutting our costs in half, So like just different perspectives. So is it okay to do wider spreads? In my humble opinion, again, this is an opinion. In my humble opinion, is it okay to do a wider spread if you're doing debit? Yeah, because mainly you're just trying to lower maintenance. So when you do debit spreads, there is some insurance piece to it. But when you do debit, you're willing to sacrifice your full premium normally anyway. Not that that's a good idea. And so by spreading it, you're usually cutting that in half, So if you're buying a $9 call, why not sell a call and bring in 450, so then it's only $450 call instead of a $900 call. Anyway, kind of fun. We are aiming for them to expire. So debit, Tim, debit, we want to get out before expiration. Debit, we want to make a nice paycheck and get out. Okay, you never normally want to hold debit for the full expiration. It's normally not advantageous. Now, credit, is it okay to hold full expiration? Because there might be other things going on. For credit, you may want to own, or credit, you may think, you just ride it till the full thing expires worthless, and that might be okay for you. So debit, no. Credit, maybe, to hold for full expiration. All right. So moving on. Yeah, and Brenda, if I were to give you one more word of the, just coming from a guy that's been doing this for a long time, I can't tell you how many people I've worked with to do further out of the money for credit, right? Doing further out of the money and being more patient. and doing a more conservative decline in premium and getting out. For debit, buying time, right? That's, you know, buy long-term, hold short-term is kind of the ism for debit. Okay. And yes, you're going to pay a lot more for the premiums when you're buying your calls or puts. But then if you're only holding it for a couple weeks, you may be paying a lot for it, but then you'll be able to get quite a bit of your money back out of it. If that makes any sense, right? All right, looks like Brenda's happy. Okay, so let's, we got 5 more minutes here, and I told you I had a hard stop, and I apologize for my router discombobulating on us here. But let's glance at Netflix. You know, can we see if we see anything revealing on Netflix? You know, first and foremost, if we look at it quickly, it was a downtrending stock. Last week, it tried to pop above a moving average, and it did. And aside from having a rough week this week, we had a rough week this week, this thing's holding up. Okay, so I might have a bullish sentiment in my head with something like Netflix. Okay, so then now it's like, okay, so we did a little analysis there. And I think it was Tim chimed in, was what do we look at for our strike selection? You know, open interest? No, we also look at pivots. So is there a pretty substantial pivot kind of at 350 on this thing on the weekly? If we were to look at the daily, you know, there's a little bit of a pivot here, but we can see where maybe 360, you know, price was dropping and then it blew to the upside. So somebody somewhere stepped in. So my attention is immediately going to be focused kind of on the 360 range. Right now, the question begs, is there going to be fat open interest at the 360 area is what I'm thinking in my head before I'm even going there. And so if we're looking here, do we see anything that's glaring? Not really. You know, and some of these are probably, you know, people doing spreads, right? So these two chunks might be a 5 wide spread somebody's doing. Same thing with this one, right? So nothing's substantial here. Again, let's look at the 360s. We can get a $2.80 premium, okay, at the 360s on a 21-day expiration. What if we were to go look at the 49-dayer at the 360s, okay? You know, it's insane, you know, are we getting substantial premium? Let's go back, look at the 21-dayer again. So in this case, are we getting close to triple premium without triple time? Again, we're almost getting triple premium without doing the triple time. And so from an efficiency standpoint, for whatever reason, the 49-day appears to be more efficient. And yes, you're going to tie up buying power, right? But it may be worth it for you, right? And so to me, it's like, I may not mind doing the 49-dayer. If I were to sell a single leg put or even do a spread, you know, the spread, there's not a whole lot of action there. There's $1 premium if you're to sell the 360s, buy the 355s on a $400 stock. So use of capital is pretty intense for the stock. But for right now, we're just having a conversation about shopping. And from a yield perspective for time, yield for time, there's an expression. It appears the 49-dayer might be better with this thing, right? And is there anything revealing on open interest? Maybe a little bit. I mean, we can see this 2,800 here at the 350s. That might be somebody selling puts down there. There's a little bit of action here, kind of sticking out like a sore thumb at the 370s, right? And is there anything we can see? Yeah, 370 kind of puts us here. And 370 kind of matches up where somebody bought back here. So the person that bought back here, could it be the same person that decided to step in and buy here? And so 370, 360, to me, looking at open interest, I think we see some revealing things here, right? That for whatever reason, somebody somewhere is willing to step in on Netflix. And wasn't it, was it Icon? I don't think it was Source. That was Icon. One of those two, Soros or Icon, one of them, him and his son like Netflix, I think. Anyway, maybe them, honestly. Okay. Kind of fun. All right, and I'm pushed up against my time. Any quick questions about, our little conversation today about just learning to shop, looking at things from different perspective. Any quick questions, last minute questions before we call it a wrap? So hopefully you enjoyed today's session and hope to see you in my weekly sessions. Okay. All right. Well, cheers, everyone. Certainly a pleasure as always, and we'll catch you next time. Take care, everyone. Have a good day and a good weekend, I should say. Right. All right. Take care, everyone. Bye now.